other one is amounts owed, sometimes called credit utilization, credit usage. This is a percentage. So it does not matter if you have $100,000 of credit available to you or $1,000 of credit available to you. What it wants to see is that you are utilizing a relatively low amount of the credit that is available to you. The example I use for this a lot of times is, let's say Crystal comes to me and Crystal says, "Hey, Casey, I need to borrow some money. I'm about to move. And, I'm not sure exactly how much it'll cost. I need to borrow some money." And I'm like, okay, well, let me ask around for a little bit. And I go to Cynthia and I'm like, "Hey, Cynthia, Crystal wants to borrow money. Have you had any experience lending her money?" And Cynthia's like, "Yeah, she had something come up with her car. I told her I could technically loan her up to $250. She only used about $50 of it. She paid me back as agreed on time every time. And she like never even used a whole $200 that I technically had available to her." I'm like, "Cool, that's good to hear." I go to Cheryl. I'm like, "Cheryl, Crystal wants to borrow money from me." And Cheryl has a similar story. She's like, "Yeah, she needed money. I told her she could borrow up to 500. She used less than 150, paid it all back as agreed. It was great." That gives me a lot of confidence. Like, oh man, Crystal doesn't overspend. When people offer her funds, she uses a modest amount, only what she needs. She does everything agreed. If I flip that, Crystal makes the ask and I go talk to Cynthia and Cynthia's like, "Yeah, 2 years ago, I told her she could borrow $250 and she used all 250, and she just keeps making the smallest amount payment she can make to be good. But like, she still technically owes me $250. I go to Cheryl, same deal. She's like, "Yeah, I told her she could use 500. She used all 500 and literally is just making small payments back and still owes me 500. I'm going to feel a little bit different about lending that money to Crystal, right? Because I'm like, oh, every person who has offered money to Crystal has maxed out that dollar amount to them. That makes me feel a little bit less safe, right? Like, am I going to be the proverbial straw that breaks Crystal's back by lending her more money, and I'm the thing that pushes her over the edge, and now she can't make all these payments, she can't get it back? So that is how your credit score fluctuates all the time. And at any given moment, what that credit score is telling a lender is how safe of a bet is it to lend this person money. And anything, Spring, great question. So Spring asked, when you have a lower credit score due to maxing out credit, how long does it take to improve credit score if you pay that down? I will tell you, credit utilization is the fastest one to fix if you have cash. So, not helpful advice if you don't have the means to access a sudden influx of cash, but if you're due a tax refund, if there is some sort of stimulus check, if you get a bonus at work or you pull some extra gig work, something happens, that credit score, you can flip that in about 30 days, depending on when, let's say it's credit cards, depending on when your credit cards report. So you get a bunch of cash into your account, you pay off all your credit card bills on the first of the month. Throughout that month, those credit cards are going to report to the bureau, and they are going to, you got one that reports on the 10th. Your statement cuts on the 10th. The day that statement cuts is the day that credit card company just takes a screenshot of your account and basically sends it to the credit bureau. And what they say in that screenshot is, how much credit does she have available? How much credit is she using of that amount? What's the monthly minimum payment she has to make? And did she make last month's payment on time? Sends that, snip, done, and then they do the same thing next month. It's not smart enough to know if that's a new balance or an old balance. So some people will be like, "Well, I'm not hurting my credit because I get the balance up high, but I pay it in full every month." That is great for you on a personal level. It means you're not paying any interest as long as you're paying that balance in full. But the credit bureau is not smart enough to know that you turn around and pay it all off. All that it knows is on the day that statement cuts, it's going to say, "Hey, she technically has $1,000 available to her. Here's where her balance is." So if you have $1,000 limit and you put $900 of bills on it, even if you pay it in full on the day that it's due on time, your utilization is at 90%. And what that says, that's going to lower your credit score, because what that says to another lender is, in this current season of her life, she is using 90% of all of the funds available to her. She is dangerously close to maxing out all of her lines of credit, she may be in distress. She may be in a situation that she can't get out of. She may have borrowed to the point that she has created a sort of snowball effect she can't get out of, and that's how they're reporting that. So that high utilization is going to lower your credit score.
Pinnacle Bank is a member FDIC and an equal housing lender. Neither Pinnacle Bank or its affiliates are a registered broker-dealer. Securities and/or insurance products are not deposits, not insured by the FDIC or any other government agency, nor are they guaranteed by Pinnacle Bank. They are subject to risk and may lose value. Registration does not imply a certain level of skill or training. The purpose of this series is to provide helpful information on the subject matter covered. It is offered with the understanding that Pinnacle Bank is not rendering legal or accounting advice. Since the details of your situation may be fact-dependent, you should additionally seek the services of a competent professional regarding your personal situation.